All right, welcome back, everybody. John Caruso here, July 27th. Of course, today is FOMC Wednesday. We're going to hear from the Fed at 1 o'clock today, followed by a 1:30 press conference with Jay Powell. We did recently hear from the Advanced Durable Goods report. It slowed on a month-over-month basis at 0.3% versus 0.7%. We saw some pretty consequential misses in earnings reports this week. We heard from Walmart on Monday. Of course, we heard from Google and Microsoft yesterday, all three of which missed on the top and bottom line. Of course, Walmart is also a proxy for the consumer. Going back to the Fed, and this was addressed yesterday, if you take a look at the Fed funds futures at the end of this year, December 2022, they are pricing in a 3.5% Fed funds rate, which is great. We know that's where the Fed has been leading the market to, but if you go out to December of 2023, they're pricing in 2.80%. Okay, so what's going on in that 12-month time frame between December 2022 and December 2023 is that the market is pricing in interest rate cuts. So essentially the market is saying that they are not buying the Fed is genuine in terms of its inflation fighting tactics, and that the Fed will likely bend the knee to the market at the first sign of any real trouble in the economy, which is a problem, okay? If we're going to extinguish inflation, because it has to be, inflation over the long term is much worse than the near term, falling stock prices and risk assets. Over the long term, the damages done by inflation are much worse than falling 401ks and stock prices. So this has to be addressed by the Fed here today. The Fed has to stay hawkish. They are going to raise 75 basis points at today's meeting. We're going to hear of clues as to where they're going to lead the market going forward at the next few central bank meetings. But the bottom line is they have to stay hawkish. And is it possible that they have to raise interest rates past 3.5%? Maybe it is. Economics 101 suggests that you have to raise the Fed funds rate to the level of inflation to completely extinguish or tame the inflation beast. Now, the other question that arises is our debt to GDP ratio, which right now is, I believe, 150% to 1 versus where we were back in the early 80s at 25% to 1. That's also a problem, and that's also going to require perhaps some higher debt payments to our debt holders in terms of us attempting to fight inflation and tame this inflation beast. It's going to take some pain, basically, is what I'm trying to say here. So, but the longer term effects of inflation are much worse for the U.S. economy than just the near term effects of falling stock prices and risk assets. So that's kind of my 2 cents of the Fed going into to that later on today. We will be back tomorrow with a full recap of the Fed. Best of luck to everybody out there. We'll catch you back here next time.